Welcome to another issue of our Profitable Home Services podcast. I'm so glad you could join us again today. Today, I am bringing on a repeat guest. We had Steve Juetten with us not too long ago, and on our previous episode, he talked to us about what does it take to be able to sell your business? Why do you want to sell your business? Some of those items. Today, we're going to go on a little bit different track. And today's track, we're going to say, we know we want to sell our business. Now what? What do we do? What are the steps? What should we avoid? What are the potholes? All those types of things. So welcome, Steve, to come back for a second interview on this very, very important topic of exiting your business and doing it well.
Thanks, Diana. I'm delighted to be here. It's an interesting thing when you said that, because avoiding the potholes, the challenges, the barbed wire, all that kind of stuff is a good way to put it. But yeah, I'm delighted. The assumption here that you and I talked about is that, okay, you've decided to sell your business. Now what? So that's where we're going to start, I think.
Right. And I know just from talking to my own clients, there's so many decisions that have to be made. And I think they can easily become overwhelmed because generally the first place they go is to a business broker. They get handed a list of about 100 things that the broker wants, and they come to me as their accountant or somebody like me and say, help, I don't even know how to wade into this. So help us with a little bit of that.
Yeah, of course. And yes, I've seen that. It seems overwhelming, but it's the old story. You eat the elephant one bite at a time. And so what I'd like to do is just give you a framework, and then we can fill in pieces. But if you think about it in these terms, it's once an owner decides to sell, the first thing the owner needs to do is get an informal valuation done on the value of the business. And here's why. Because you need to know if it's worth going through these steps, because people have an overinflated idea of what their business might be worth. And just for argument's sake, let's say you think your business is worth $500,000, but in fact it's only worth $200,000. Is it worth going to the trouble to do that? And you can get an informal valuation done. And you and I have talked about this, Diane. I don't want a business broker to do that. Brokers have their place, but we don't want them doing evaluation. Really, people need to go to their educated and informed CPA or accountant to get an informal valuation. We're not talking about great depth of detail in this. We just want to know kind of a range of what the business is going to sell for, because from there, then you can go to the next steps. So the first thing to do is to verify what you think the business is worth. Does that make sense?
It does. And I'm glad you said that. Let's take a look at what it could realistically be worth. Even if it's a fairly wide range, it's at least is setting the stake at here's where we're going to start.
Right. And we'll talk about this at another time, but the number one reason that businesses fail to sell is because the owners have an unrealistic expectation of what the business is worth. But I digress. Let's go back. So let's say you talk to your CPA, or I'm a business exit coach and I can do evaluation the same way, but you get a number and it's okay. This seems like it's about right. Then the next step is to take a step back and assess the business. How does it look from a buyer's perspective? And this is the number one mindset point to make, is you need to assess your business, but from a buyer's perspective. How would a buyer look at your business? And one, or you say that?
Guess that's probably a completely different perspective than me as a business owner. This is my baby. I've worked hard in this business.
Yes.
How do you really step outside your own mindset and how do you look at it objectively from a buyer's viewpoint?
Well, that's an excellent point. And I use the real estate concept sometimes. And most people have sold a house, right? Well, you're selling a house that you have cared for or raised your family in and maybe improved and everything else. And you always think the house is a castle. And then a buyer comes in and thinks of it as a hovel with all the things that are wrong with it. It's the same thing with the business, just like you said. It's my baby. So this is it's a mindset item. But if you're intellectually honest about it, we suggest clients do something called a SWOT analysis, SWOT, which is to sit down and list the strengths, weaknesses, opportunities, and threats, and be honest about that. And I find that most business owners, if they stop and think about it, they really do know what they do well compared to the competition. And they know what their weaknesses are, and then they can look at what the opportunities are in the business and what the threats are. And a really simple example about a threat is if you're in a business in which technology is going to have a negative impact on your business, that's a threat. There's a business that I worked with, and they do real estate appraisals, or blank land that somebody wants to build a commercial building on. Well, the technology has now taken over so much of that business that they've had to change their business, because with the advent of drones, for example, they no longer have to go out and visit the site. They hire a local drone person to launch a drone, and the drone does the site visit for them. So strengths, weakness, opportunities, and threats. So that's the second item. First is valuation, a rough valuation. The second one is do that strengths, weakness, opportunities, and threats. And then this is one where they're going to come back to somebody like you. And if the business is not worth what it is they would like it to be, or if there are weaknesses in the business, you need to improve it. And that usually means, what do we need to stop doing, start doing, and keep doing to improve the profitability of the business? That's the number one thing that a buyer is going to look at. And Diane, you and I have chatted enough to know about this. You can look at it, you can look at the numbers and decide how to improve the profitability of the business. And there are opportunities in there that you can look at and have a conversation. This is where a profit coach can really come in handy and look at what's being done or not being done in order to improve the profitability of the business. Therefore, it's more attractive to a buyer.
Well, and I think so many business owners, especially in the home service industry, don't realize that there's probably, I don't know, 50, 60, 70 different areas we can go look at in their business and look for ways to improve it. They think of one or two. Okay, I've improved my business, but have you thought about your team? Have you looked at your profitability on your jobs? Have you looked at your vendors for your jobs? Have you looked at how your expenses are being spent? Have you looked at your CSRs? Have you looked at, and the list just goes on and on and on places that they can improve profitability in their business.
That's excellent. And you know more about it than I do, but I am always amazed at how many areas you can do to improve the profitability of your business. And some of them are little and some of them are big. That leads me to something that I wanted to mention to you. The second most often question I get from people is, how long is it going to take me to sell my business?
Okay.
And I will be really honest with you. The answer is it depends on what price you want to get for your business. So if for health reasons or something else or a family illness, you need to exit right away, then you can typically sell a business in 6 to 9 months. Okay, that's how quickly you can get it sold, but you're not going to get maximum value out of that. If you want to get maximum value, it's probably going to be more like 2 to 3 years, because you need to make those improvements. It takes a while, and it takes a while to make those improvements on the balance sheet, on the operations, and the people, or whatever the case may be. So when somebody says, how long does it take for me to sell my business? I usually say it depends. What's the goal here? If it's to exit right away, then you can do it right away. But if it's to maximize the value or to get as much as you can out of the business, it's 2 to 3 years. So just back to finish up the 5 steps that I was mentioning before. The 4th step after you've improved your business is that then you would start marketing it. And that might be where the broker might come in handy. And then the last one is the final sales step, which is where the T's are crossed and the I's are dotted, and we've assessed the tax impact and all that. But it's those 5 things. If somebody wants to think about selling a business, once they've done that, first get a valuation. Second thing is do a self-assessment, or you can use an outside person to do the assessment. Then go ahead and prove the business, and that's the longest part of this, and that's 2 to 3 years probably. And then market and sell the business. How's that?
So that's a long process potentially.
It is. To get maximum value, it's 2 to 3 years. I have clients that I start to work with 5 years out. And usually in that case, it's a more complex business, but 2 to 3 years. And the downside of this is that many times an owner won't be ready to sell her or his business until they're so tired or so worn out or so sick of the business They don't want to take the time to do it. And that's a mistake. You've got to, if you want to get maximum value for the business, plan for it, allow enough time.
Very good. So, how does a business owner go about finding somebody to buy their business? Do they have to go to a broker? Can they find them themselves? Do they go to an attorney? How do they find this elusive buyer out there?
Yeah, it's a great question. And it's the part where it may be right in front of the business owner and he or she doesn't realize it. They just have not looked at it that way. So if you're looking, you can use a broker, but for the moment, let's just talk about a DIY sale. You're going to sell it yourself.
Okay.
So first, and it depends on who you have on your team. So if it's a solopreneur, if it's a person that they are their only person, this doesn't apply. But otherwise, you look internally first. Is there somebody on your team that you could either groom or train to take over the business? And the value of that is that for customers, that's the least disruptive. So if you, even if it's a two-person operation, listen, if Sally is selling the business to her right-hand person, Jane, clients are going to know that and they're going to feel the best about it. So we always tell people, look first internally to see if you can find a buyer, and then work with them to see if they can do it. Many organizations have a key person, and that person might be the operations person or just somebody that's been trained. But first look internally. And then if you have to go outside, if there isn't anybody internally that you want to sell a business to, then you look at competitors, believe it or not.
Really?
Oh yeah, most competitors are more than happy to take a competitor off the field and get a client base, right? And so just think about this for a minute. Give me the type of a business one of your listeners might have.
Let's say a roofing company.
Roofing company, perfect. So there are, I don't know, depends on the area, but there's usually a couple of dozen roofers, right?
Mm-hmm.
And if one of them, a good competitor, somebody that you hate to go up against, you can approach them and say, I'm thinking about getting out of the business. How about if you take over my customer base and I sell the business to you? It is very expensive to get that customer base. It's very expensive to duplicate operations and crew. By the way, one of the big things, you've got a trained crew, or you've got contractors that you know, like, and trust. Well, that's a valuable part of the asset. And if you went to a competitor in a good way and say, I would like to transfer this over to you. What do you think? Can we have a conversation? Those are very rich conversations. And one way you can do it is just turn around and say, look, if your competitor is the ABC firm and you're the XYZ, if the ABC firm came to you and said, we'd like to sell you our customer base and our crews and everything else, would you be interested? Well, that's the next place to look. Look at your competitors.
Okay.
Another place to look for it is just in industry groups. Now, I presume many of your listeners are in different industry groups, whether it's a roofing industry or a plumbing industry or whatever it is. If you go to industry events, you will meet other people that you might not know, and you can sort of confidentially let people know that you're interested in selling your company. One real quick story, true story. There's a company, and I'm in Washington State. There's a company that I know over in Eastern Washington, over in the Moses Lake area, and they do cable installations for commercial buildings. So they come in and they cable your business, right? Well, the owner was at a industry conference, and one of the big national firms pulled him aside and said, John, we've been thinking about expanding into the Moses Lake area. And the fact is that it would be much easier for us to buy a firm rather than to move in and create our own organization there. If you're ever interested in having a conversation, here's my card. Well, it just so happened that John and his wife had been thinking about that. So if you go to these industry conferences and you can meet other people and have conversations, it's always fascinating to me. Another way to find people that are interested in your business, this is one of my favorites. Think of people that do a service right before or right after what you do.
Okay.
Because you can fill in for them. So we're going to use the roofing company as an example. All right. So Diane, think of a business that would occur right after you do, right before or right after. If you've got, do you have a type of
Right,
business?
right after could be solar.
Is a good one. So
Mhm.
you could go to a solar company, and in fact, you probably know them because they've come in right after you've done a
Mhm.
roofing job. And you could say to them, how would you like to expand the product line? And the other one that I was thinking of, if you do roofing, how about a window replacement company?
Okay, okay.
Find
So,
businesses that are right before or right after you, and those are potential buyers. Because again, this is the issue, is that moving into a new area is expensive. And so trying to organically grow a business is expensive, and you're not going to be profitable. But if you have a profitable company now, any buyer, any entrepreneur, any business is going to be interested, and you can have a conversation with them. So again, three things. Look internally first, see if there's somebody, or maybe a family member. Second, look at competitors, and then go to industry kind of conventions or organizational meetings, and then look at businesses that are right before or right after you. And if you just think about it a little bit, you will come up with half a dozen or a dozen different companies that you can approach and approach them confidentially. And again, if you've got a good story to tell, any business owner wants to hear from you. Believe me,
okay,
they're always looking to grow their business because, as you know, a business is either growing or it's declining.
right.
And most businesses would love to grow more. And if you present them an opportunity, here it is, they're going to be interested and you can have a conversation. How's that?
That's very, very helpful. So let's say we found our person. We're moving along down the line. Paperwork is starting to happen. Is this where we have to have a broker? Do we need an attorney? Who do we need at this point in time to make sure it all happens nice and tidy and legal?
Well, you do need an attorney no matter what happens. You're going to need an attorney, and an attorney fulfills many roles. It's whether you're using a broker or not. Just some of the things that an attorney is going to do. Obviously, you have their legal expertise. They're going to be in the business of drawing up contracts. They're going to
Okay.
help you with due diligence. They're going to help you prepare your firm accordingly. Many attorneys also can help you structure an agreement to avoid future liability. So the attorney plays a critical role in both the negotiating process and the ongoing and the final sale agreement. They're also going to know about the laws of your state. And we're going to get to this in just a second. But there are two people for sure you're going to need on your team if you're selling your business. You're going to need your attorney, an attorney, a business attorney, right? Not somebody that does family law or something like that. You need a business attorney. And the second person you're going to need is a CPA. And one of the things that I always get from clients is, okay, what are the tax implications of selling my business? And as I'm talking to a tax expert, after all, can I throw this one back to you? What are the tax implications of selling a business, Diane?
You can, and then I have a question for you
Sure.
that we'll come back to. So tax implications are we may have some capital gains tax that's owed, and we may have some ordinary income tax that's owed that could be driven from a sale of equipment. When we've depreciated equipment over the years, in recent years especially, we've had bonus depreciation. And bonus depreciation has allowed us to accelerate the writing off of equipment. Well, now we want to sell that business, and that's going to include the sale of some equipment, which means that we will have some depreciation recapture, which will come in the form of ordinary income. Our whole goal is to have capital gain income, if at all possible, because we'll pay a lower rate on that than we will on the ordinary income. So then that leads you into, is this a stock sale or an asset sale? And if it's an asset sale, more than likely we'll have ordinary and capital gain income. If it's a stock sale, we'll have capital gain income. So it's completely different tax ramifications. And the good news is there are a lot of amazing tax strategies that can decrease that tax by a huge amount or even take it away altogether. So we don't have to let the taxes slow us down on the sale of a business because there are planning opportunities around that.
Good. Well said. For example, when I sold my business in 2022, and we split the sale over several years to decrease the tax impact. And you probably know that in the state of Washington, they just instituted a capital gains tax for the first time. We don't have income taxes in Washington, but they instituted a capital gains tax above a certain level, blah, blah, blah. So my tax accountant was so helpful in that regard. And just like you said, decreased my tax liability significantly, which was
Right.
very
Yes.
impressive. And I was ever so grateful.
I want to leave this topic for a second. Come back to something that you said right before we started talking about the taxability piece of this. You mentioned that the seller should be utilizing their attorney to do some due diligence. It feels like in working with my clients that the purchaser is doing a bunch of due diligence on my business, your business, whatever it is. But you mean I can do due diligence back to them?
You are
Talk
such
about
a
that,
good,
if you
you are
would.
such a good listener. That is a common misconception that sellers don't understand. You have to do due diligence on the buyer. And I have a story to illustrate for this. There's a woman that I know that is actually a friend of ours. She sold her business, and she had built this business up, and there's a service business, and she had 6 or 8 employees, and she sold the business. But a year later, so 12 months later, the buyer defaulted on payments,
Oh, no.
and she ended up getting the business back. The farthest thing she wanted, because by then the business had been wasn't well taken care of. So in this case, I'm not Monday morning quarterbacking. I'm just looking from the outside. She didn't do due diligence on the buyer. And the due diligence process, so your attorney and you as the seller are going to do due diligence on the buyer. And you have every right to do that. And in fact, you must do that, because I'll just use this as an example. You need to know how they're going to pay for it. You need to know how the buyer is going to pay for the business.
Okay.
You need to know if, for example, are they going to do a loan? Are they going to do an SBA loan? Whatever it is that they're doing. You also need to know what is their business like, because you don't want to turn over your customers to somebody that isn't going to treat them well. In general, you want them to go to somebody that's going to treat them well, or the way they treat their employees, or a company that is not financially stable. So the first document you sign is an NDA, or non-disclosure agreement. Both sides agree that we're going to open up our books and we're going to show everything, but we can't tell anybody else. That's an NDA.
Okay.
Again, the attorney will help you draft that. The next thing you do, and in the NDA, you are very broad when you say this gives us the right to do complete due diligence on your business, both ways.
Okay.
And I've had more than one business that when they initially were interested in a company, when they did a little due diligence, they decided it wasn't a good fit, either because of customers or because of the way that they're paying for it, or whatever the case may be. Because in some cases, when you have a business that's being bought out, it's not a cash payment up front. It's usually going to be, in most cases, it's going to be some cash up front, but also an earnout over a period of time. Well, if the business that buys your business, if the buyer doesn't have a solid business going forward, you may never see the rest of it. One of the cynics that I know in my industry says that he never lets his clients assume that the amount that they're going to get includes any earnouts or any money that's paid down the road. He's a bit of a cynic, but he's been burned a number of times. So he tells his clients, look, the only money you can count on is the money you get up front. And that's because unless you do really good due diligence, you may end up selling your business to somebody that, for whatever reason, doesn't pay you. But absolutely, I'm glad you brought it up. Due diligence.
I had that happen to me. I sold an accounting firm down in California. All I got was the down payment. In looking at the agreement that I ended up signing, there was a little loophole in there that had to do with the number of my clients that remained with him over certain periods of time. And if we didn't hit those numbers, he didn't have to pay anything. And he was so arrogant and talked down to my clients that of course he didn't hit those numbers, and he didn't have to pay me anything. All I got was my small little down payment.
The upfront money. And I did not
Yeah.
realize that. And that does happen. So I'm always a believer in hiring your own attorney, and a good buyer will welcome the due diligence. A good buyer will realize that you as the seller are trying to make a good deal for everybody. But if the buyer doesn't want you to do due diligence, run, don't walk away.
Okay.
And I hate to say this, but most of us only sell a business once, but most buyers buy multiple businesses, so they know a lot more about it than we do. So the people that are listening to this conversation, I doubt that they have sold businesses very often. And so you want as many people on your team as possible. And at a minimum, it's the attorney, experienced business attorney, and a CPA.
So what are some of the other things that you and I should be saying, we wish we would have known this when we went through this process? I mean, you had a successful sale. I had a sale that turned out going in the dump, or whatever you want to call it. In hindsight, what are some of the questions we should have asked?
That's an excellent question. So you can jump in on this as well. So I characterize this as, what are the things that I know now that I wish I had known then, right?
Mhm.
And so the couple of them jump to mind. First of all, one of them is that it's really hard to both run a business and sell a business, be in the process of selling a business at the same time. There's, as soon as you make the decision to do it and start actively looking to find a buyer, or even if you're working with a broker, it just changes. It's another job, for one thing. And once you've made the decision that you want to leave, it's a lot of work, and it's hard to do both. And I didn't realize that. And I don't know, at the time I had like 8 other people that worked with me, and I couldn't tell them what was going on, right? And we would do planning, and we would say, okay, well, what either short-term or long-term planning. In the back of my mind, I knew I wasn't going to be there, or the business wasn't going to exist. And it just created all this conflict, and the degree of secrecy around it really bothered me, because I was talking to a variety of companies, and as it turned out, I sold my company in 3 parts to 3 different buyers.
Oh, wow.
So yeah. Well, so that's one, is that it's hard to do. And I wish I had realized that. I would have allocated my energy and probably changed my expectations a little bit. The second item for me, and I know you know this, it's an emotional roller coaster.
Oh, definitely.
Yeah.
Yes.
Ups and downs. And there were days when I was just sick of the whole thing. I just wanted to either backtrack and say, no, I'm going to work until I die, or I'm done. I'm just going to close the doors and everybody can fend for themselves. And neither of those are reasonable. They're very emotional. And that's the roller coaster. And then there are other days, which is, yes, this is finally going to work. I'm going to be able to go do what I want to do next. And it's that up and down that I was not prepared for. And I don't think enough business brokers and business exit coaches talk about this, because it's an emotional roller coaster as you go along. And would you agree?
Oh, definitely. I remember being so angry at times, and then hopeful at other times. And it's like, then you hit the little area of, will this actually ever happen? I'm starting to give up faith. I mean, yeah, it was very emotional. One thing I would mention from my experience is I would want to dig into what their core values are. Because if their core values don't somehow mirror your core values, your customers, your clients, your patients, whoever's listening to this recording, your customers are not going to be treated the way you've built your business. You can have the best SOPs out there, you can have your team trained, but if this new company comes in, and in your company you value integrity, timeliness, quality of work, great customer service, professionalism, all this stuff, and they come in and they don't mirror that, your customers start exiting and there's nothing to stop them from leaving.
That
And
is
that
an
was something I ran into with mine. I didn't know it at the time, but our core values did not match.
that is an excellent point. And that's what I mean about due diligence. So when you're doing due diligence, one of the things you want to find out is the way they treat people, the way you would treat people, your customers and your employees, if you have them, or contractors or vendors or whatever. That core value conversation is very important to have a good match for the reason you said, because your clients will, or your customers will vote with their feet. They will
They
just,
will.
okay, I have one real quick story for you. It's a dentist. Okay. Everybody can relate. So we had a family dentist that my wife and I and son went to for a long time. And then he retired and he sold his practice to another dentist. And we got a letter or an email that said, okay, Dr. Johnson has sold his business to Dr. Smith, and please keep your regular appointments. So I thought, okay, well, that's good enough. I trusted Dr. Johnson. He was a great guy. But I went in to see Dr. Smith. I hated the guy. And that was the last time I ever went in there. And he was just the opposite of Dr. Johnson, who was kind and considerate and professional and a good guy to be with. And Smith was kind of a smart aleck and made a couple of comments that I didn't appreciate very much. But there's an example, is that was the last time that I went in. I was willing to give him a chance because Johnson sold him the business, but that only lasted for one visit.
One visit, you bet.
And customers have options, and so that core value match is absolutely essential when you're doing that. And had you known that, you might not have sold the business, right? You might have sold to somebody else.
I wouldn't have. I would have kept running it.
Or found another buyer or something. Yeah.
That was a painful lesson to learn,
That's
because I had my clients coming to me for a year or two afterwards saying, "Oh, here's what's going on. We've held into this point. We can't hang on any longer." So then I want to ask you a question. Will you sign this non-compete agreement? How bulletproof are those? I had people asking me, will you take me on just out of your home, anything? Fortunately, I moved home to Idaho and my answer was yes. And I still have some of them 30 years later.
So I didn't know this question was coming up, so I'm just going to give you a general answer, and then you may want to supplement this in your newsletter. So the Federal Trade Commission has just announced that non-competes are no longer valid.
Yeah, I saw that in my email.
Yep. And so I don't know all the details of them, but in general, non-competes are no longer legal. So you cannot even, so a buyer can't put that in there in the agreement. It's not legal anymore. So it's not enforceable. And that's going to make it, so this is a conversation for an attorney and a business consultant and you and me. So what is that going to mean? If they pay you for the business and you turn right around and compete with them, that's not going to work very well either.
No, not very well.
The thought that I had, and this is just a couple of colleagues having a conversation, it would lead me back to, why am I selling the business in the first place? And why do I want to get out? And if all I'm trying to do is make money, then I could go ahead and sell the business and then bring all the customers back with me. But they're going to find that out. I mean, the buyer is going to find that out. And that's not acting in good faith at all. And something is going to blow up along the way. So my belief is that the seller of a business needs to go back to, why am I selling this business anyway? Is it because I want to retire? Is it for health reasons? Is it I want to go do something different? Is it I just want to sit on a beach, whatever? So even in this era when it appears as though non-competes are no longer legal, I don't think you want to compete with the person that buys your business.
Yeah, I don't think you do either.
It goes back to this due diligence thing. In your case, you sold the business because you were moving out of the area. I get that, right? And so maybe it's a little bit different, but it does change things. Absolutely. Isn't that interesting?
Yes. Yeah. And in that era, it was definitely pre-internet, pre any of that kind of stuff. So they literally had to mail stuff to me for me to help them. And, it has worked. I still have a few of them 30 years later, because the level of customer service we gave was 1,000% higher than what he was giving when he bought my business. So,
well, most of your clients are hands-on, or many of your clients are hands-on delivery of a service in the home area, correct? And correct?
Yes. Yeah. They're pretty much working within a geographic area.
Yeah. So they're working in a geographic area. So it could be the same scenario, which is they want to stay in the business, but going somewhere else. But if you're in the same area, you're probably selling the business because you don't want to do it anymore or can't do it anymore or are tired of it or whatever the case may be. But yeah, that is an interesting. I have a non-compete with my agreement. And one of the questions that was signed when non-competes were allowed. Now I don't think that's valid anymore, but I don't want to do that business. So it's fine with me. One of the other items that I was just going to mention, you said, what do I know now that I wish I knew then? I didn't spend enough time thinking about what I was going to do next.
That's a good
So
one.
when I sold my business, I was so focused on serving clients and working with my team and helping the transition go to the new buyers that I didn't give enough time to think about what I would do on what I like to call the day after. So my business sold on June 30th. So on July 1st, what was I going to do? And as a result of that, I spent, and I'm still spending time kind of navigating my way through that, and I wish I had spent more time doing that. So it's the one caution that I give to business owners. If I'm having a conversation with them, we're going to talk about what's next for you personally. What is it going to look like? And you need a plan that is what we like to call day one. So what is going to happen the day after you sell your business? It's a little bit like a wedding. There's all this emphasis that goes on a wedding, and the wedding is a day, it's an event, and maybe there's a honeymoon after that. But what do you do the day after you come back from the honeymoon? Because I like to tell people that a business exit is an event, but it's not the end of your journey. You're going to have a life. And so I engage with clients probably more than I might have because I didn't do a good job with that.
And
How about you?
I think so often our identity is tied up in our business. That's who we are. Even though, yes, in my case, I'm a mom, I'm a wife, I'm a grandma. I'm Ms. Adept Business Solution. That's who I am. And people see me that way. They see me as the tax coach, the profit coach. And to step away from your business and not have thought that out, what are you going to do with yourself?
That is difficult. And I will
That
tell you
would be.
this from my experience as a certified financial planner. The loss of identity is a big deal.
And it's
And
real. It's real.
it's very real.
Mhm.
I helped a friend of mine sell his business, and for about 18 months afterwards, when people said, "What do you do?" he could not say, "I am retired." He couldn't
Okay.
because he didn't see himself as retired, but he didn't have another label. And so he would stumble around, and I called him on it. I said, "Dude, you're going to have to come up with an identity because you didn't cease being a human being when you sold your business. You still have other things, a father, a friend, and he's a tremendous outdoors person. So now he says, I'm a retired business person, and now I spend my time in the outdoors. Oh, okay.
Perfect.
You're a retired business person. Now you spend your time mostly in the outdoors. But he needed to find an identity, and that's how he identifies now. So I think it's a great point. I generally think men have more trouble with this than women do, by the way, Diane.
Probably.
We aren't
Probably.
we aren't very adaptable, unlike our better halves.
My husband retired just from a regular job almost a year ago now. And it was a little hard for the first 6 months, I guess, around our house because we had our routines, we had our roles, and all of a sudden those lines got muddy because now he's home and he's in a nice way, he's butting into my kitchen, he's butting into the laundry, he's butting into the cooking, things that he always was totally hands off because he had his roles, I had mine.
Yeah,
And it was a little bumpy there for a bit until we figured out what this new life looks like. So it's got to be the same way when you sell your business. What does this new life look like? What do I want it to look like? You got a
right.
clean slate. You got a chance to start all over again. What do you want to do?
And that's going back to the question of how long does it take to sell a business. That's why you cannot just wake up one day and have the business be gone, because the answer to that question if you've been a business owner for as long as you and I have been business owners, you don't switch that identity just overnight.
No.
And it takes some time to think through it and figure out what it is you're going to do and what your new identity label is going to be, and that takes time. So again, if you have to sell a business in a hurry, we can, but it isn't advised. 2 to 3 years. Let's find a way, because part of it is you got to have figured out what's going to happen after the sale for you personally.
Right. Yeah.
Yeah,
Well,
good.
Steve, we can't end this session without coming up with a profit leak for these people. I don't want to break my record. We found one in every single episode up to this point. Let's come up with a nice solid profit leak that we can plug by just knowing a little bit more about this topic.
Sure. So believe it or not, there is one that's in my business, and it's called SDE, Seller Discretionary Expenses.
Oh, yeah.
And perhaps you've talked about this with your clients, but when you run a business, you end up running a fair number of your discretionary expenses through the business, and that is a profit leak. And instead, and I'll give you a simple example. You probably pay your cell phone through your business, which is legit. I get that.
I
Do
do.
you also pay the cell phone bill for your whole family through your business? There's a leak for you. And there's a myriad of other things. And so it's called SDE. And in many cases, when a buyer is looking at a business, they will identify those SDEs, they're called, and that's a profit leak. And so if you want to make your business look better, take a look at your SDEs. How's that?
Very good. That is a very unique profit leak that we have not talked about on any of my other episodes. So thank you.
You're very welcome.
Yeah.
And I would be happy to have you write about it in your terrific newsletter, because it's something people sort of inadvertently fall into. But it's a leak nevertheless, and in some cases it can be substantial. And I assure you, if you're going to sell your business, the buyer is not going to miss those. They look for those.
Very good. Well, thank you again, Steve, especially for coming back to part 2 of our interview. Would you share with our listeners how they can get in touch with you? Because I know that there are some people out there that need an exit coach.
Sure. Well, there's 2 things that I would say. One is that I have a free special report people can get that talks about the 5 steps of how to exit a business. And they just need to go to www.simplebusinessexit.com. So simplebusinessexit.com. And if they want to reach me, they can go to my website, which is bridgegatepartners.com. All one word, bridgegatepartners.com.
Very good. Thank you again, Steve. This has been another amazing episode. And thank you for just being willing to share your time and to share your expertise with these home service businesses that need this information so badly.
You're very welcome, and thank you. I always enjoy conversations with Diane. I'd be happy to come back anytime.
You bet. We'll come up with another topic we can pull you back in on and
Excellent.
have you in again. Until our next episode, I'm going to challenge you to be proud to be profitable. That's my newest mantra in my coaching groups, is that we are proud to be profitable, and we wear that badge wherever we go. So often people look down on us. You're a business owner, a greedy business owner, because you're making profit. And it's like, oh, no. We are proud to be profitable. So join us in the Proud to be Profitable group, and we'll see you next week.
Thank you.